Hi there, Nicholas Campin here with another instalment in the First Formations video blog series. Today we're looking at company shares and whether you can transfer them to your children. And to do this, we'll go through reasons why shares are transferred to children, how the actual transfer takes place, and a brief look at the potential tax implications of those transfers themselves. Transferring your shares to your children, who need to be minors under the age of 18, is a great way to get them interested in the world of investment and to teach them about financial markets. But there are a number of important points that you need to consider before making the decision to give them shares, including tax implications and any company restrictions that might be in place. A lot of public limited companies flat out forbid child shareholders, and private companies too will often include a provision in the Articles of Association that prevents shares from being held by a person under the age of 18. Now, the reason that some UK companies have concerns about children being shareholders is because in England and Wales and Northern Ireland, they are deemed not to have legal capacity to enter into a contract. As a result, this could relinquish any shareholder obligations they might have, for example, paying unpaid shares. That can make it tricky for the company to attract investment later down the line. Scotland has slightly different rules in that the legal capacity to enter a contract starts at the age of 16. Anyone considering transferring shares to their children should first check if there are any rules about minimum age requirements for shareholdings contained not just in the Articles of Association of the company, but the shareholders' agreement. Now, there are a number of reasons why you might transfer your shares to your children, and the first of which is in the case of an estate. Individuals with significant share portfolios may prefer to resolve questions about inheritance by essentially distributing their estate to their children and their loved ones whilst they're still alive. Next, there is tax efficiency. Now, for smaller investors, getting some of their shares to their children may help relieve the tax burden, although this is usually minimal. There may also be a desire for keeping things within the family. If shares are held in a family company, gradually transferring these shares over to their children can be a way of ensuring that the business remains family-run for the foreseeable future. And finally, there are the financial lessons that can be gained. Parents who like their children to take an active interest in finance and investment may be able to pique their interest by giving them some shares of their own. So whatever the reason for transferring the shares to your children, it's important to understand the issues and restrictions that could arise from such actions. And it may actually be beneficial to seek the advice of an accountant or a solicitor. So that's why you might transfer your shares to your children. Now let's talk actually how we go about undertaking it. Now, it looks here, the procedure, to be a long and convoluted one. But actually transferring your shares to your children is just like transferring shares to anybody else, which in itself is usually rather simple. The first step of transferring shares is to complete a stock transfer form, also known as either a J10 or a J30. The information this form will need includes information about the company's name, the amount of consideration to be paid, which will often be nil or zero, a description of the security, which is usually the share class, which is often ordinary shares, simply ordinary shares. You also need to provide the number of shares that are being transferred across, the name, address of the current shareholder, that's the parent, together with their signature, and the name and address of the person receiving the shares, which in this case would be the child. Finally, if the transfer is not subject to any stamp duty, then the stock transfer form will also need to be certified as being exempt by signing one of the certificates on the reverse. Now, at this point, the stock transfer form would normally be sent off to HMRC for stamping in cases where the consideration value is greater than £1,000, and as well to process the actual payment. But in the case of a parent gifting the shares to their children, this step isn't actually required, as there will be no stamp duty to pay. The form should then be checked by the company, and in the absence of any provision in the Articles of Association restricting transfers to minors, the share transfer would normally be accepted. Approval of share transfers ordinarily is a straightforward process, necessitating only a board resolution or set of board minutes. A new share certificate would be issued to the child in question, and this should be done within 2 months of the transfer being accepted by the company. Now, the company itself should then retain the form and as well as a copy of the original share certificate they produced. The register of members should then be updated to reflect that the transfer has taken place. Now, you're not actually required to inform Companies House immediately of share transfers or new shareholders coming on board, and you can wait till the next one is due, although you can file an early confirmation statement if you so wish. Now, First Formations offers a complete share transfer service, which includes all of the aforementioned documentation, including stock transfer form, board resolution, and share certificate. Finally, let's just take a look at the potential tax implications for transferring shares to children. Now, the first one we need to cover is capital gains tax. Shares transferred to children will be classified as a disposal for the purposes of capital gains tax, unlike if you were to transfer them to a spouse. To work out the level of tax payable, the difference must be calculated between the value of the shares when they were initially purchased and the value upon their transfer to the children. If this figure exceeds the annual capital gains tax allowance, either on its own or in the combination of with other capital gains tax matters, then a tax rate of either 10 or 20% will need to be paid, depending on the level of income. When transferring a large number of shares, it may be worth considering spreading this over several years in order to take advantage of the multiple capital gains tax allowances. This can significantly reduce your tax bill. Next, there is inheritance tax. When you transfer shares to your children, it's generally considered as a gift for the purposes of inheritance tax. If the transferor dies, which in this case is the parent, within 7 years of making the transfer, the transferee, which is the child, will be liable to pay inheritance tax. The level of tax that needs to be paid will depend on the number of years that have elapsed since the gift was made and the death. And the actual amount you pay is based on a sliding scale known as taper relief. You should note that up to £3,000 worth of gifts can be made each year without being subject to inheritance tax, and this is known as the annual exemption. So one way to transfer your shares to your children whilst minimising your tax burden is to do yearly batches of £3,000. It is possible to carry any unused portion of the annual exemption forward 1 year, although you can only do this for 1 year. You also need to remember that if you transfer shares to your children for less than the market rate, the portion between the sale price and the market value will generally be considered as a gift by HMRC. This sort of gift is known as the potentially exempt transfer and will be subject to the normal rules of inheritance tax. Last but not least are dividends. Now, dividends are normally paid to shareholders out of the profits of the company. Children under the age of 18 are entitled to receive the first £100 of income from savings or shares tax-free. But anything over this amount will be added to the income of their parents and attributed to them for the purposes of income tax. As such, any tax efficiencies in respect of share dividends are generally negligible here. But the Stocks and Shares Junior Individual Savings Account allows children to hold up to £9,000, that's the 2020-21 limit, tax-free. Children can take advantage of the Junior Individual Savings Account from the age of 16, but they cannot withdraw money until they are 18. A more complex alternative to such an account is for the parents to create a trust. The shares can be invested in the trust by the settlor, which in this case is the parent, who will then specify the beneficiaries, which are the children. A trustee then needs to be appointed to manage the trust. And there are many types of trusts out there, but the most common one that's used for managing assets for the benefit of children is known as a bear trust. Once the beneficiaries reach the age of 18 or 16 in the case of Scotland, they will be able to access the shares held in them and sell them on if they wish. And that's it. So today we've looked at why parents transfer shares to their children, how they can do it, and the tax implications that they need to be aware of when they undertake it. If you have any questions, please leave a comment. And don't forget to like this video and subscribe to our channel if you'd like to receive more videos just like this. We'll see you next time. Cheerio.